You are looking at the daily market charts of Australian dollar and United States dollar. How easily can you identify the head and shoulder pattern in the market chart? To trade successfully is to understand the technical analysis behind price movements. First step is to observe the chart closely. Looking at this chart, what do you understand? The head and shoulder pattern influenced the movement of prices. It changed the direction of the trend. When you watch this pattern closely, you will notice that there were pullbacks at different points before the trend reversal. Here is the head of the pattern and the left and right shoulder. Their formation gave rise to this inverted head and shoulder pattern. Pullbacks that happened during the formation of this pattern forms a support level. This support level, when broken, means that prices are likely to continue movement in that direction. Next, an illustration of the pattern. Here is your left shoulder, the head and right shoulder. Let's highlight the neckline. Remember, in the head and shoulder pattern, the focus is on the breakout of price at the neckline. A bullish spinning top closed above the neckline. A spinning top shows indecision in the market, and here it simply means the market direction is still very uncertain. A bearish candlestick appeared, driving prices down. If you have made the spinning tops close your entry in the market, and your stop loss is level below the pattern, then your entry would have been terminated by the bearish candlestick. The bullish candlestick broke the neckline convincingly, so it's an opportunity to go long. Your entry point should be at the close of the candlestick. Before you make an entry, make sure the candlestick has closed, because an active candlestick is unpredictable. When you go long, it will look like this. Place your stop loss below the right shoulder. If you noticed, the breakout made an engulfing pattern here, so you can place the stop loss level below it. The take profit should be the height of the pattern, from the neckline to the head. So, always measure the height. The target level doesn't give you a good risk to reward ratio. Trades like this are risky. This is because what you will be losing is huge if the trade goes against you. What do you do in this situation? I will share with you solutions to this challenge. The height of the pattern isn't enough for a good target level. You can accurately predict the future direction of the market by observing the previous price movements. Prices are likely to react to pullbacks at support levels before the formation of the pattern. There was a pullback here as prices trended down, before it continued in the trend's direction. In technical analysis, prices tend to react to these levels, so set your target below it. Mark out your target level. This should be below the high of the pullback. This is a better risk to reward ratio compared to the previous level. When trading using breakouts, long candlesticks sometimes poses a challenge to the expected return. So, most traders won't execute their trade using this breakout. Going long with these breakout means your stop level will be lower, and this can incur more losses to you if the market goes against you. Remember, when it comes to this pattern, apart from trading on price breakout, you can enter the market if price breaks out and makes a pullback at the neckline. Though the pullback didn't touch the neckline, it is also close to the horizontal support level. After the pullback, prices formed a reversal candlestick pattern which signals a reversal to the upward direction. Let's highlight this pattern. Trading with FID strategy will make you avoid false breakouts, because some of the breakouts you will encounter in this pattern will be a false breakout. Your entry level should be after the formation of the pattern. This strategy offers a higher chance of success than breakouts, but you might miss out on an entry, because sometimes pullbacks don't happen. Make sure your target level is below the high of the previous pullback. The stop loss level could either be below the neckline or slightly below the reversal pattern. When prices reached the previous pullback level, it reversed, hitting the horizontal support. This explains the importance of observing the support levels in the market chart. When you don't get it right, you will miss out on the best entry and exit levels. And these two are crucial to traders. Another good way to make the best choice of entry points is using lower time frames to execute your trade. This chart is on the daily time frame, so when a bullish candlestick closes above the neckline, go to the lower time frames and look out for entry levels. This also applies to this support level. This strategy gives a higher risk to reward ratio